There are various different retirement vehicles that are available, but choosing what's best for you often takes some in-depth knowledge. Sure, you could rely on a financial advisor to put your financial future in their hands, but no one cares about your money like you do. If your goal is to buy a beach house and retire in a tropical paradise, or sell everything you own and travel the world after your working years, it's important to make sure your finances align with these goals. You're probably familiar with a retirement income based on dividend payments from stocks and index funds, cash flow from rental properties, living off the capital gains income from stocks, or simply spending down the principal of your investments. But many people aren't very familiar with how annuities work and whether or not they're a solid choice for them. Will they provide the lifestyle of the rich and famous that you've always dreamed of? Probably not, but here are the basics broken down so you can make an educated decision. If you enjoy videos about money, personal finance, and investing, all topics that will help you better your financial future, consider subscribing to the channel and hit the notification icon to be notified of new videos. If this video is helpful, make sure to hit the like button. An annuity is a contract you sign with an insurance company, such as Prudential, Charles Schwab, or MetLife, stating that you will pay a certain amount of money in exchange for income paid out on a regular basis. You can make a lump sum payment or a series of smaller payments made over time to the insurance company in exchange for payments made to you, immediately if you're ready to retire, which is known as an immediate annuity. Many people choose to take their payments at a predetermined date in the future, when they turn 65, for example, which is called a deferred annuity. There are a variety of disbursement periods to choose from. For example, you could choose a plan that makes payments based on a 25-year schedule, or you could choose a plan that will pay you until death. Obviously, the longer the time period, the smaller the disbursements. But there is certainly an advantage to guaranteed income for the rest of your life, so there's no need to worry about running out of money if you're stuck in a wheelchair. There are 3 different types of annuities: fixed, variable, and indexed. Fixed annuities pay out a fixed amount based on how much money is in your account. Like with any guaranteed investment return, the gains are very low and usually only slightly higher than a certificate of deposit or a CD. Earnings from CDs are very low when compared to a broad market index fund invested over the long term. Currently, CDs only pay around 2 to 3% compared to the average return of the S&P 500, which is approximately 10% per year. If you have a higher risk tolerance and more room for error in your retirement planning, you could choose a variable annuity. There's more opportunity for growth with this investment because it allows you to choose from a variety of mutual funds. With this, your payments during retirement are based on the growth of the investments. Lastly, indexed annuities can be a great balance of risk and reward. You will receive a guaranteed minimum payment while part of your disbursements is based on the return of an index such as the S&P 500. Although these variable and indexed annuities have the potential for greater returns, the fees are often higher than fixed income alternatives. Many people are forced to pay steep fees if they try to withdraw their funds earlier than anticipated. If a retirement investor is looking for guaranteed income instead of hoping their stocks will continue to appreciate, annuities can be a solid option. A fixed annuity can be a good alternative to CDs, whereas a variable annuity can be good for long-term, tax-deferred growth, and an immediate annuity can be beneficial for those looking for income right away. It's important to keep in mind that annuities are a form of insurance, which will ultimately lower risk. The insurance company is insuring a certain return, which obviously has a cost associated with it. These investment vehicles are for people who need income security. Maybe they don't have much saved for the future, or they don't want to rely entirely on the stock market to put food on their table for the rest of their lives. Instead, they prefer to purchase an annuity and know how much money they're going to receive on a monthly basis. Regardless, it's not a bad idea to consider diversifying your income streams, especially during retirement. For those who are nervous about what our future income situation will look like, annuities might be a good choice. The biggest advantage of purchasing an annuity is the ability to tailor it to your personal situation. If you're extremely healthy and you're worried about outliving your investments, you're not alone. That's a very common fear among retirees, but annuities can be designed to provide income until you die. After all, The last thing you want to worry about in your final years is whether or not you can afford to keep the lights on, or be forced to depend on your kids for financial support. The main reason people purchase annuities is to hedge against longevity risk, or living longer than expected, even though they're not always the most efficient investment vehicle. Also, receiving guaranteed payments can be reassuring even if returns are likely to be lower. Just think of the peace of mind that guaranteed income brings. Like with a 401k, your balance grows tax-free and disbursements are subject to ordinary income tax. However, any contributions made to annuities don't provide a tax break for the year contributed. In other words, a $10,000 contribution to a 401k will reduce your taxable income by $10,000. This is not the case with an annuity, which is why it's suggested that you take advantage of other tax-efficient accounts first and consider these as secondary options. If you have an employer-matched 401k, contribute enough to get the entire match. Then consider investing in a Roth or traditional IRA, where you can purchase the lowest cost investments, such as low-cost index funds, ETFs, and even individual stocks. It depends on your situation which one makes the most sense for you, but try to contribute to the one that is likely to provide you with the lowest tax bill. Any withdrawals from the annuity made before the age of 59.5 will also be subject to a 10% penalty, just like with a 401k and IRA. Beware of any fees and penalties that most annuities have for a variety of circumstances. Surrender charges if you choose to take your money out too early, administrative fees, mortality and expense fees for variable annuities, which are typically around 1.25%, and fees for extra options are something to keep in mind. Most of these fees charged with annuities are avoided with other types of investments. Like with all investments, keeping fees in check will reduce the amount of your savings that is depleted. When you withdraw the funds from an annuity, the money is taxed at ordinary income rates, like with a 401k. For most people, ordinary income rates are higher than the capital gains rate, which is what you'd pay if you had invested in individual stocks and held on to them for more than 1 year. For example, if you're in a 25% income tax bracket, that's significantly higher than the long-term capital gains rate of 15%. Your balance will grow tax-free, but disbursements will be subject to ordinary income tax. Annuities have no contribution limit, unlike traditional retirement accounts. Meaning, you could contribute $100,000 in a single year if that makes sense for you. But with a Roth IRA or traditional IRA, only $6,000 per year can be contributed for most people. However, brokerage accounts with Robinhood and other companies have no contribution limit either. While annuities are sold under the promise of guaranteed income with no exceptions, it's smart to be aware of potential pitfalls. The insurance company might not be able to make the payments if they run into financial turmoil or end up going out of business. If you have a fixed or index annuity and the company goes under, your investment could be at risk, which could definitely throw a wrench into your budget. With a variable annuity, you will probably get to keep your underlying investments, but you could lose any returns or benefits. While the chances of encountering an issue with a large, reputable company is unlikely, it's always a good idea to diversify your retirement investments so you're not relying entirely on the future financial situation of one company. We all know that unexpected issues could arise. If you enjoy having flexibility with your investments, you might not want to put too many of your eggs into an annuity. With an annuity paying a fixed amount, it's not possible to use the funds for a new car or a second home without significant penalties, like you would be able to do with a traditional retirement vehicle upon meeting the age requirements. You'll need to be content receiving the payments based on the predetermined amount, whereas with other investment accounts, the funds can be withdrawn without penalty once the age requirements have been met. The only real way to determine if an annuity is a good investment for you is to have a plan. Your plan should dictate what your investment goals are and show you how to make choices that help you accomplish these goals. Typically, investors tend to stick with other retirement accounts, such as 401ks and IRAs, that have fewer limitations that dictate what's reasonable for you and your money. However, if you want a guaranteed outcome, an annuity might be a good choice. It might be worth speaking with a professional, but remember, no one cares about your money like you do. Retirement planners who have a nest egg large enough to fund their lifestyle beyond their working years, or individuals who have multiple streams of reliable income, probably won't find much use for an annuity in their life. The best option is to always have multiple income sources, whether those be cash flow from rental property, income from a business, a part-time job, royalties, or something else. Nothing is ever guaranteed, so having more than one money generator will hedge against risk and decrease the likelihood of ever running out of money.